let's go ahead and get started. Today is Wednesday, September 6th, 2 p.m. section. This class is being recorded for being published on YouTube. So as we get started today is the first day of attendance. So this is the attendance sheet. There will be one every time we take attendance. Very important that you sign this sheet. If you don't sign the sheet, you'll be considered to have an unexcused absence for that section and that day. So I'm going to start over here on this side of the room, pass it around, make sure you sign only for yourself. And this is the attendance tracker. I will also be posting a link on the announcements tab. So over the course of the semester, you can see if you have any unexcused absences, okay, based on the attendance tracker. So it'll be a Google Doc for that. Okay. Aren't you section 201? Are you section 201? That's 201. Is your name not on there?
Well, I see names from the people in our class.
You see names from the people in your class?
No, people in the prior class.
Okay, you can try 301. Oh, all right, I'm going to make a mistake for you. Start writing on the back. Put in your name and UID on the back. All right, so back to this. Also, unfortunately, numerous students emailed me that they got COVID over the weekend. So be careful. It's obviously out there and around for Labor Day. And keep your distance. I don't want you coming anywhere near me if you have COVID. Okay? I don't need to get it. All right. So back to this. Today, we're going to talk about three things. We're going to continue on lecture note 1. And in an hour, so right around 3 o'clock, we are going to select your Bloomberg Challenge trading captain and start group project on Bloomberg trading competition. Okay? So, in Elms, under people, there's a tab called 443 Teams. I believe this is section 201. So at this point, these are the 6 201 teams, 201-1 through 201-6. Team can't have more than 8 people. If you're not currently in a team, drag yourself to one of these teams. You have to do that within the next hour. Okay? So basically, if you've already selected a team, great. If not, make sure you put yourself on a team. Okay? At 3 o'clock, I'm going to give you 5 minutes to meet your new teammates and select a team captain who will then be registered today to start the Bloomberg trading competition on behalf of your team, because that starts today. Okay? We'll get to that around 3 o'clock. All right? And I want to talk briefly about homework 2, which is the Disney homework assignment. All right? So before we begin all that, any questions about homework 1, the screenshot you had to turn in? Hopefully no problems doing that. All right, so let's talk about some content. So, clicking down on the 4 cornerstones of value creation is what McKinsey calls the key value drivers, or KVD. This is all the math for valuation, kind of summarized on one PowerPoint slide. Okay? And what it says is, at a high level, 3 things matter to value: spread, growth, and sustainability. Meaning, how long does that spread last? How long does that growth last before you either mature or go away? Okay, nothing lasts forever. Darwin's constantly at work. And when you look at ROIC, ROIC is a function of 2 things: your profitability, profit margin, how much you make, and your efficiency or productivity, how much you spend to make it, how often you make it. So 5 things are going to matter: margin, productivity, cost of capital, growth, sustainability. Those are the 5 most important factors when it comes to valuing a company that we're going to focus on this semester. Okay? Now, also last week were 2 other important definitions that we introduced. One is we defined an attractive industry as an industry with a positive spread. We define an unattractive industry as an industry with a negative spread. This is an absolute definition for industry attractiveness. We also said that competitive advantage was relative performance to peers. So outperforming the industry spread in this class is competitive advantage. If you don't outperform the industry spread, you don't have competitive advantage. So those are the two definitions that we are going to use. Okay? I also want to define a few more terms. This comes straight out of the reading for this week. So, 1, NOPAT, also known as NOPLAT. Okay? When we talk about the operating value for a firm, okay, it's basically how much operating cash flow do they generate. So what is the company's operating profit? And you're going to have to pay taxes before investors get it, so operating profit after tax. The acronym is NOPAT, net operating profit after tax. McKinsey's version of that is NOPLAT, net operating profit less the applicable taxes. All right? They're basically the same thing. Right? NOPLAT, interchangeable terms. NOPAT, generic, NOPLAT, McKinsey. Okay? But here's the point. We're going to take a hypothetical company that has $100 million of operating profit after tax, your EBIT after tax. Now, when we define operating profit, this is before interest. So no financing is being taken out here. It's just if you made profit, you were in no debt, how much profit would you take? What would you make? Okay? Now, there are two things that a company can do with its profits. It can either reinvest them back in the business, or it can pay them out to investors. Okay? And that creates two additional ratios. The percentage of the profits reinvested in the business is called the reinvestment rate. The percentage of the profits paid out to the investors is the payout rate. Now, companies will overcomplicate things. And what I mean by that is we're going to say any money that's put back into the business is reinvestment. Well, they can say, well, I could reinvest in property, plant, equipment. I can reinvest in inventory. I can reinvest in other working capital. That's just reinvestment. I could pay out a dividend. I could buy back stock. I could pay off my debt. I could pay out interest. That's just payout. Okay? So at a high level, you either reinvest or you pay out. Okay? Those two ratios have to add up to 100% of your profits. Therefore, 1 minus the reinvestment rate is the payout rate. 1 minus the payout rate is the reinvestment rate. Payout plus reinvestment is 100% of the profits. In this simple example of a made-up company, they make $100 million of NOPAT. $50 million or 50% is reinvested. $50 million or 50% is paid out. Okay? Everyone with me so far? I also then want to define two additional terms, G, which is called the sustainable growth rate, little g in our formulas, and free cash flow. I'm going to start with G. G is the sustainable growth rate. That means the rate of which a company can grow with internal funds. Any rate beyond that growth would require some sort of external financing. You need other money to grow. Okay? Now, to calculate G, let's take this hypothetical company that makes $100 million and this hypothetical company which is reinvesting $50 million. I'm going to throw out an additional assumption, 10% ROI. It made 10% in the past. It's going to keep making 10% in the future. Just keep the math simple. Well, if it reinvests $50 million at 10%, it's going to grow $5 additional million of new profits next year. Okay? And if it keeps making 10% on its core business, the core business is going to make another $100 million. So over here on the right, last year the business made $100 million. Next year it'll make $100 million on the core, keep making 10%. Makes $5 million on the new investment, 10% of 50. It's going to grow to $105 million. 105 versus 100 is a 5% growth rate. Okay, that's just kind of mechanically how we would calculate the growth. Here's the shortcut. The shortcut says that the growth, the G, is the reinvestment rate times the return on the investment. This company reinvests 50% of its profits at a 10% ROI. 10% times 50% says that it can grow 5% sustainably. That's the G. That's the formula for the G. Okay? Now that's very important to understand because it tells me the two things that drive my ability to grow. So let's say that I take over this company and I want to start growing this company at 10% a year. How do I do that? If I want to change the G from 5% to 10% using this math, what could I do? I have two options. What are they? Yeah. Increase the reinvestment rate to what? What percentage would it have to become?
100%.
100% reinvestment times 10% ROI is essentially a 10% G. But if I make it 100% reinvestment, what happens to my dividend? I gotta go to zero, because now I have to have a zero payout rate. Companies may not want to go to a zero payout rate because investors might be used to that payout rate. Okay, so that's one of the challenges. Not saying we couldn't do it, but one way to grow is to throw more money at the business. So let's say I don't want to cut the dividend. What's the other way I can get 10% G? Yeah.
Improve rate of return to 20%.
Yeah, suddenly all my businesses start making 20 versus 10, which I can just snap my fingers and magically have it happen. That's not always easy to do, but that's the point. If I can get a 20% ROIC at a 50% reinvestment rate, that's a 10% growth rate. Okay? But what it says is two ways to grow sustainably. One, I can grow by putting more money in the firm. But the other way I can grow is if I have a high ROI, I don't need external financing. You ever wonder why companies like Google, which is Alphabet, or Meta, which is Facebook, or why Apple have so much cash on their balance sheet? Right? It's because all those companies have extreme ROIs. Right? So let me show you how this would work. So if we go to Bloomberg, and let's say I look up Google, which is Alphabet, and then I go to RV, and then I go to custom, and from here I go to our template, spread template from last week. So the first row down, market cap rate average, second row down is Alphabet, which is Google's ROIC. And I see that Google's ROIC last year when this loads was 21.57%. I'm going to round off and call that 22%. All right, so over the last year, Google made a 22% ROIC. Let's assume it continues in the future. Now, I know the Department of Justice is trying to break up Google right now for monopoly, right? But let's just say that Google wins that fight and they still make a pretty good rate of return in the future. So 22% in the future. What is Google's payout rate? How much are they paying in dividends? Does anybody know? Well, I'll give you a hint. If you go to EEO and you scroll down, it's called DPS, which is dividends per share. Dividends per share this year and into the future, 0. Google doesn't pay any money out. They don't really buy back stock and they don't really pay any dividends. So what is Google's payout rate? 0. So what's their reinvestment rate? So what is their sustainable growth rate? What is Google's G? How fast can they grow with internal funds? What was their ROIC again? 22%? 100% reinvestment? What's 22% times 100%? 22%. They can grow with internal funds at 22% a year. Okay? Now, here's the point. I need you to understand two important assumptions that are always made in finance. Without stating it, we assume that growth in revenue and growth in profits grow at an equal rate if the margins are constant. Okay? So if the company's margins don't change, growth in revenue, growth in profits, interchangeable. That's why we'll often use growth in revenue as a proxy for growth in cash flow. If the margins change and they're different, then that relationship breaks. The other assumption we make is that growth in profit equals growth in cash flow, free cash flow, because we assume the similar level of productivity, similar reinvestment over time. So the same concept. If the reinvestment rate is going to change over time, then income and free cash flow growth are not the same. But if reinvestment stays the same and margin stays the same, growth in profit, growth in revenue, growth in free cash flow, similar. Okay, that's why we'll start interchanging those terms with that being unset, right? So back to this. Google can grow its revenue at 22% a year. right? If these are the forecasts for the next 4 years, right here in revenue, row 13. If I go to headline growth, it switches these percentages. This year, Google's going to grow at 8%, then 12, then 19, then 11. Does Google need to borrow money to fund that growth externally? No, it does not. How fast can Google grow this year? In 2023, how fast can they grow this year? 22%. They're going to grow at 8. What's the difference between 22 and 8? Where does the other 14% go? If they generate enough cash to grow at 22 and they only grow 8, what do they do with the other 14 cents if they're not paying it out? What happens to that cash? Yeah. Is what? It's just going to go on their balance sheet. And we know right now that Google's cash on their balance sheet, that balance is going to keep growing, right? Because they make so much money that they don't need to reinvest it all, and they're just going to keep it, and they're not paying it out. So they're just going to have more and more cash on that bigger and bigger balance sheet. Does everybody see that? And so this is actually important for another reason. I want you to understand this conceptually. Those companies that I mentioned, those tech companies with high returns, they don't need banks to fund themselves, right? Because I have such a high return, I can self-fund. The rule in banking is to lend money to people who don't need it. And if I don't need it, if I'm Google or Apple, I can borrow from the banks at very low interest rates because they're kind of begging me to take the cash that I don't need. Flip side, what about an Uber? How do you think this changes if we look at Uber? We were talking a little bit about this last week. What is Uber's growth rate? Look at row 13 for the next 4 years. 18%, 17%, 17%, 15%. Pretty high growth for Uber, which is row 13, as percentages. Everybody see those data? Okay. Just type Uber right here. Go to the second tab. It's called headline growth. Headline is the dollars, growth percentages. Okay. Now, here's the point. Past doesn't always equal future, but let's look at Uber's current ROIC. So back to custom RV. What is Uber's ROIC? Negative 2.64%. Everybody see that number right there? So here's the point. Do you think Uber's paying dividends? I didn't go back to the screen, but they're not paying dividends. Like I'm losing money. Why would I pay dividends? So they got negative 2%, 2.6% ROIC times 100% reinvestment. What is their ability to grow? They can grow at negative 3%. Well, how does a company that can grow sustainably at negative 3% grow at 17? How's Uber going to do it? They got to borrow money. I know that Uber needs external money to fund that growth. So they have to borrow new cash, or they have to hope that they raised enough money previously to raid their bank account, and they're going to start burning the cash that's on their balance sheet. I know that Google is going to basically make money, they're going to invest a lot of stuff, and they're still going to add cash to their balance sheet. That's what's very important. And oh, by the way, that's the other thing. The companies with poor ROICs, generally to grow, they need external capital. And that's not the time to go to the markets, because the markets aren't interested in giving you good rates on that or lending you money at all. So it's ironic that when you're performing poorly, it's actually hard to access capital, and that's the time you need it. When you're performing well, it's easier to access capital, but that's when you don't need it. Welcome to the real world. All right, does everybody understand that? Second concept I want you to understand, free cash flow. Companies are not worth the sum of their future profits. Say that again. You're not worth the sum of your future profits because you can't take those profits and pay them out. Buy a brand new car off a lot today. Keep that car for 10 years and don't do any maintenance on that car. I'm telling you, that car is not going to make it 10 years. Well, the same is true for a company. Companies are going to fall apart if we don't reinvest in them. Right? The buildings are going to crumble. The infrastructure is going to go away. The IT systems are going to get old. You got to spend money or the company's not going to basically maintain itself. And if the company wants to grow, it's going to have to take some of those profits and put it back in to fund the growth. So the problem is I can't pay out the profits because I have to reinvest. What I can pay out is the profits after the reinvestment, right? The challenge is the accountants don't have a term for that. It's not under GAAP. Profit after reinvestment does not have an accounting definition. So the finance people created their own definition. Profit after reinvestment is called free cash flow. That's the cash that can be paid out. It's the theoretical payout rate, and therefore it's the operating value of the firm. Your future free cash flows, your profits after reinvestments, that's your value. Okay, and that's what we're going to focus on for operating value this semester. So in this case, 100 million of profit, 50 million of reinvestment, 50 million of free cash flow. I either pay out all 50 million or stick in the bank. But either way, it's my theoretical payout rate, some combination thereof. If I'm Google, my cash balance goes up by 50 million, right? If I'm a more mature company, I might take all 50 million and give a dividend or buy back some stock, right? But I have a choice with that 50 million, but that's the idea of free cash flow. Does everybody get that? This class is about free cash flow, right? That's the idea for valuation. The problem is free cash flow is really hard. I was talking to a big company's controller recently, and I was like, we got to talk about your free cash flow. And she's like, our accounting systems don't calculate this. Like it doesn't even come up as easy for us to do. And that's one of the challenges with free cash flow, is that the accountants don't calculate this. We have to manually rearrange statements to calculate this. You're gonna learn how to do that. That's the second section of this class. You're gonna hate the mechanics of it, but it's kind of critical to understanding company valuations, okay? But here's the real point. What is free cash flow? It's the cash from the income statement, the cash flow from operations, minus the reinvestment in the balance sheet. Cash from the income statement minus reinvestment in the balance sheet, conceptually, is free cash flow, okay? Free cash flow is hard. But here's what I want you to understand. How does it translate to value? This is why it's important. So I know there's a lot of data on this slide, but this is a very critical slide to something I want you to understand this semester. So we've been talking about this hypothetical company A. They had 100 million of profits that reinvested 50 million at 10% and had a 5% growth rate. And let's just assume that I'm going to add a peer. We'll call it company B. Right? And this peer has similar risks. So both companies have a 10% WACC. Okay, so no different in risk. And let's say company B has similar growth rates. Company B is also going to grow at 5% a year sustainably. So both companies start with 100 million of profit, then 105, 110, ... So you have two companies with identical profits to start with, identical growth in profits, and identical risks. Is either one of these companies more valuable? Is A or B more valuable than the other? And if so, why? Given the data on the screen, is one of these two companies more valuable? Yep.
So if value is determined by the amount of free cash flow company has, you say company B then
You're exactly right. So B generates more free cash flow than A. So B would actually be considered more valuable than A, even though they have the same profits. Does everybody understand that? But I want you to understand the why. Follow the why, okay? Why does B generate more free cash flow? 100 million of profit becomes 75 million of free cash flow here. 100 million of profit becomes 50 million of free cash flow here. Why does B generate more free cash flow? And the answer is because it doesn't invest as much to make the profits. Now let's assume it's not cutting corners, it's just better at what it does, but that's the point. B being better at what it does doesn't spend as much to make the same profits. The reason why is because B makes an ROI of 20% on its investments and A makes a 10% ROI. And that is the important part I want you to understand. If you have a higher return on investment, you will generate more free cash flow and you will be more valuable, caveat, at the same level of growth. If we take growth out of the equation, ROIC equals free cash flow. ROIC is easy to calculate, free cash flow is hard to calculate, they're the same thing. That's the McKinsey approach. McKinsey's approach is because free cash flow is so difficult to calculate for most companies, and ROIC equals free cash flow. ROIC is much easier, and so McKinsey's an ROIC-based valuation book. That's the book that you have in front of you, and that's why it's actually popular, because it's a more practical approach. Okay? Not saying that we don't want to get to free cash flow. It's just it's easier to proxy it with ROIC, okay? Because ROIC equals free cash flow, and there's the math to prove it. Because one of two things is going to happen. Either, and assuming you're not cutting corners, but if company B really is better at what it does, it makes a 20% ROIC, it doesn't have to invest as much to generate the same profits, and therefore will generate more free cash flow. Or, what happens if company B invested 50 in year one, not 25? What happens to year two profit of company B? If this were 50, not 25, what would their year two profit be at a 20% ROIC? It'd be 110. It wouldn't be 120. 110 minus 50 is more than 105 minus 53. So here's the point, and this is the key to all of this, which is I'm either going to do one of two things. I'm either going to invest less to make the same profit, or for the same investment, I'm going to make more profit. In either case, I'm going to have more free cash flow. That's the idea. And ROIC is related to free cash flow, and here's the math to prove it. You're worth the sum of your future cash flows. Now, the difference between a company and a project is we assume companies are going to be around for a very long time. They kind of last forever. Projects end. If I'm going to value a cash flow for a long time, it's called a growing perpetuity. Okay? The math formula for a growing perpetuity is right here at the bottom of the screen. Cash flow divided by R minus G. Cash flow is your free cash flow. Your R is your cost of capital or WACC, and your G is that sustainable growth rate. Tell me those three things, and I'll tell you the long-term value of a company. All right? Now, there's two problems with that formula. Problem number one is it's kind of overly simplistic. We're taking the entire value of the firm, we're putting it into these three numbers. Get over it, it's what we do. Okay? But this is the real value of the firms. Problem number two, though, is a little more complicated. This formula, which we use in the real world, it's academic textbooks, people talk about it all the time, assumes that the IRR on historical projects is the same as the IRR on future projects. Translation, whatever return on investment you make now, you continue making forever. Google makes 22% now. Google will always make 22%. It will never go down. Well, that's not realistic. Eventually, all companies mature. And so the point is, it tends to overvalue firms. This formula also undervalues firms. Take Uber, which has negative 2% now. Apply this formula, it's going to make negative 2% forever. It gives Uber no ability to do better, and it will tend to undervalue Uber if it has a chance of doing better in the future. So the formula that we use in the real world that you're taught in business school has a flaw in it, and that's the flaw. Whatever your current ROIC is, it never changes. Okay? So this is where McKinsey tried to improve upon this. And the improvement is called the key value driver formula, which is a rearranged perpetuity. This formula on the right-hand side of the slide is critical to our knowledge this semester. And here's what McKinsey said. They're going to say with the same growing perpetuity the academics use. Just going to rearrange the math. And they're going to say cash flow is free cash flow, which is profit after reinvestment, profit times 1 minus the investment rate. Sustainable growth is the investment rate times the ROIC. Therefore, the investment rate is the growth over the ROIC. So we're just rearranging the growing perpetuities. This is a growing perpetuity, but it has 4 factors in it. And one of the factors specifically is ROIC. See, I can't change the ROIC in this version of the growing perpetuity. I can change it in McKinsey's growing perpetuity, key value driver equation. That ROIC is incremental, which means using the McKinsey key value driver, I can have a different ROIC that represents my future than my past. With the traditional growing perpetuity, I can't. Okay? Now, I have one ROIC for the entire future of a company. So if I'm doing Delta, I might think 22%, or Google, 22% may not be realistic forever. I might put in 15%, But I gotta still put in something I think is realistic about their future to value delta. But that's the idea. I can do that with the key value driver equation. And that helps with valuations. And that's the formula we're gonna use this semester. Questions so far? Make sense? All right, so a minute ago, I asked you to tell me which of these two companies was more valuable, and you basically said the one on the right, company B. All right, here's what I want to do very quickly. I want to use the key value driver equation to answer that question more with math. So in Excel, I'm going to do two companies, A and B, and I'm going to take the data off that PowerPoint slide. What is my expected, I can type today, my expected profit? Each of these two companies started with 100 million, A and B, on that slide. What is my expected growth? Both of these companies were going to grow 5% sustainably into the future per year. What is the expected ROIC? Well, company A was expected to make 10% a year, and company B was expected to make 20% per year. And what is the WACC, cost of capital? Both companies had 10% WACCs. So that's just the data from the slides. So here's what I want to do. I want to take this formula and figure out which company is more valuable. So basically what I'm going to do equals left paren profit times left paren 1 minus the growth divided by the ROIC, right paren divided by left paren, WACC minus growth. If I put in those values, company A is worth $1 billion. Company B is worth $1.5 billion. So I'm just quantifying what we intuitively said was true a minute ago. Company B would be worth 50% more than company A, given those values. Now, in the real world, there's something called a price to earnings multiple, PE. What is the price to earnings multiple that company A would trade at? What would A's PE be? What's their price to earnings multiple? Yeah. Yeah. Because their price is $1 billion, their earnings are 100 million, they would trade at 10 times earnings. Company B, their price, their value is $1.5 billion, their earnings are 100 million, they would trade at a multiple of 15. This is why in section 4 of the course, I'm telling you that multiples are very much related to DCF. They have to be. It's just rearranged math. But the key value driver formula helps us understand that. And the point is, why is B more valuable than A? Why do I pay more for B's earnings than A's earnings? Why do I pay more for their 100 million than the other companies? What's different? That's the only thing that's different. If you have a higher ROIC, you will generate more free cash flow. You will be more valuable. That's the math. Does everybody see that? Caveat at the same level of growth. Okay? So here's the thing. If I start with 20 cents and I grow that at 2% a year forever, and I start with 10 cents and I grow that at 9% a year forever, which one's going to be worth more? 10 cents compounding at 9% a year, 9% growth per year compounded, or 20 cents compounding at 2% a year forever? That's the point. It's the growth return combination that's the real value. Okay? That's what makes it more difficult. So if I make this 20 cents growing at 2%, and I make this 10% growing at 9%, and I'm going to make the WACCs for purposes of the equation, 9.5. Then A will eventually be more valuable than B. We're going to get into this more next week, but that's the whole idea, is that what makes valuation tricky is it's the growth ROIC combination, right? And then we discount it. That's it. That's all valuation really is. But we're going to obviously get a little bit more detailed, but that's the idea of key value drivers. Let's talk about EIC. This is part of your homework too. This is the first section of the course that we're kind of getting more into. E stands for economy, I stands for industry, C stands for company, EIC. EIC was brought to the Smith School by Sarah Kroenke. Sarah Kroenke was an analyst at Wells Fargo Securities before she became a professor here. She kind of brought in Wall Street's approach, the EIC formula, to how they evaluated the external conditions of companies and industries, okay? So this is used in the real world, but the general idea is if half your performance is your industry, how do we know what's going on in that industry and the economy? And more importantly, how does that affect the industry or company that we're actually dealing with, okay? So it's a reverse pyramid. Starting E is macroeconomics, okay? So let's talk about Delta Airlines. So what about the macroeconomic environment is going to affect the airline industry, okay? And I'll give you a hint. I talked to you about this last week. 20 to 25% of an airline's cost is fuel. So oil prices are very important to airlines. So when Saudi Arabia says that we are going to continue to extend the cuts of oil and join in with Russia to keep production globally low, to basically do two things. One, they want Trump to win next year. They don't want Biden to win. And two, they want to keep oil prices high. So they're going to restrain capacity to try and push oil prices higher. Well, that affects airlines. Because if oil's $80 a barrel versus $120 a barrel, which it was last year, which is where they're trying to push oil back to, because they kind of like making 120, that is going to hurt the airline industry. Okay, that's what we mean by economic sensitivity. Now, I work with another company called Dentsu. Dentsu is one of the big 5 ad agencies, kind of the madmen. So basically, global ad agencies. Do you think Dentsu is going to be as sensitive to changes in oil prices and the ad agencies as an airline like a Delta? And the answer is probably not. And so that's the point. Different economic things will have different impacts on different industries. That's what we're trying to figure out. For the industry and company we're looking at, what are the key drivers of economy and how might they be changing and how might they affect the industry? Now, to start this conversation, because it's very real world, homework 2, you're going to do this on Disney and Disney's industry. So how sensitive is the entertainment business to changes in the economy? That's part of your homework 2, okay? To help you, screenshot number 1. A rising tide rises all boats. A falling tide falls all boats. ECFC, as you're doing your Bloomberg certification, is economic forecasts. It defaults to the US. But I could change the country to UK, I could change it to China. But the point is, if I'm looking at US companies like Delta, primarily, those are the next 3 years of expected GDP. 2% this year, 0.9% next year, 60% today probability of recession in the near term. The economic conditions are getting worse for all the companies in the US. And if we have less GDP, that means all the companies are going to have less money to try and make. The pie is not growing as much, right? So how does that affect an airline if we have 0.9% GDP versus 2% GDP? Well, people probably aren't going to travel as much. There's going to be less business travel. There's not as much economic output. So airlines might be a little sensitive. So we go to screenshot for your homework assignment. RV. Go to RV. Go to Markets, subtab, Beta, subtab. This is the industry beta, the market cap weighted average, and the beta of every airline. There's a raw beta, there's an adjusted beta. In this class, we're going to use the raw. The adjusted just uses a smoothing coefficient that statisticians throw in there. All right? To keep it simple, we're just going to use the raw beta. All right? So, industry raw beta today for the airlines is 1.32 for U.S. big airlines. What does that mean? What does it mean to have a 1.32 raw beta? I'm sorry? How is it risky? Yeah, what does it mean to have a beta of 1.32? If the market goes up 1%, what's going to happen to the airlines? They're going to go up how much?
1.32.
And if the market goes down 1%, what happens to the airlines?
They go down 1.32.
So they're going up 32% faster and down 32% faster than the market. That's going to suggest economic sensitivity. Okay? These airlines are more likely to be cyclical. They're booming and busting. So when the times get worse, they get even worse because the market's heading down, they're going to go down faster. When the market goes up, they're going to go up faster. That's the risk. They're more volatile. Okay? Now, Delta, their raw beta is 1.30. They're a little less sensitive than the industry of 1.32, but they're pretty sensitive too. All these airlines have betas, with the one exception of Copa, all right, basically above 1, which suggests economic sensitivity. So that's your homework assignment. Take a screenshot of this screenshot. You don't put in this, you're not going to get graded for homework 2. This is one of your screenshots you have to submit. Except it's on Disney. Your homework is on Disney, not Delta. Okay, but I'm using Delta as their proxy. Questions about that? And ideally, besides giving the minimal answer, why? Why is Disney's beta higher or lower? What makes it higher or lower? And Delta, we just talked about it. They're related to fuel prices. People travel less and more in economic times. Like, you'd say a couple of those things. So what's going to matter for Disney? That's the E. Questions about the E? The next part of your assignment, minimum 500-word paper, is the I. I stands for industry. This is screenshot number 2. Custom spread. What is the industry spread? The industry spread is the industry ROIC against the industry WACC. We said that a positive spread is an attractive industry, value creating. A negative spread is an unattractive industry. Right now, the industry spread, 9.11 ROIC against a 7.83% WACC, slightly positive spread, slightly attractive industry. Explain. Explain using Porter's 5 forces model that spread. Whatever spread you see, explain it. Why does this industry have about a positive 1.3% spread using the 5 forces model? That is the first part of the I. Okay? Porter's 5 forces: supplier power, buyer power, barriers to entry and exit, substitutes, rivalry. Okay? That's the forces. Here's the model. Okay? You guys should all be familiar with this at this point. If you're not, Google search it, Wikipedia it, whatever you got to do to learn it. But nonetheless, this is your industry. And by the way, if you're overwhelmed by all this stuff beyond the fact that this is being recorded, remember TAs have office hours tomorrow and Friday. Take advantage of that as well. But back to this. Using the 5 forces model, why is the airline industry slightly positive spread? Well, first part, supplier power. 2 suppliers. I just gave you one of them. Oil prices. They don't have control over oil prices, and oil prices kind of work against the industry right now. That's working against the industry spread. That's actually hurting the industry spread. The other thing is labor. Airlines in general are having tougher times with their labor unions in the U.S. because they got rid of a bunch of people during COVID, and now they're trying to hire people back. They don't have the people to come back, and the people that were there that took the pay cuts are upset. So you got 2 airlines right now, Southwest and American, who have not cut deal with the unions. It's getting pretty acrimonious, and there might be a shutdown of one of those 2 airlines if they don't agree to the union's terms for higher labor costs. Delta and United agreed to union labor demands and raised their costs dramatically because suddenly people had power over the airlines. Didn't work that way pre-COVID, but it is right now. And that's part of the things that are working against the industry spread. What's working for the industry spread is buyer power. Because right now, you don't have a lot of power for 2 reasons. One, the flights are full. We saw 89% load factors when we looked at Delta Airlines last week. And if the flights are full, then they can charge higher prices. And part of the reason why they can charge higher prices is lack of rivalry. Try flying out of BWI. What airline are you likely to fly if you fly at a BWI? Southwest, because it's the major hub there. If you tried to fly out of Miami, what airline would you most likely fly? Who's the big hub in Miami? It's American. If you tried to fly out of Atlanta, who would you probably have to fly? Delta. If you fly out of Chicago, who would you have to probably fly? United. These airlines have created these mini fortress hubs, mini monopolies, regional monopolies. It's given them pricing power, right? Because if you want a direct flight out of BWI, you're probably going to fly Southwest. Because if you want to go from here to someplace and you try Delta or United, you're going to have to connect. It's more inconvenient and it's probably going to be even more expensive. So that's the point. Their regional pricing power has eliminated some of their rivalries. That tends to favor the spread. There's high barriers to entry. You can't just start up an airline. Costs a lot of money, huge regulation, and oh, by the way, all the gates are full. So where's your airline going to park even in an airport? Okay, so that's the point. It's not easy for these startups to just come and get the big four, who has 80% of the market today, to basically disrupt that in the short term. And substitutes. You want to fly from DC to South Florida? You're going to drive? You trying to get there? You take Amtrak, right? You're going to fly. And so that's the point. Substitutes for long distance travel, airlines don't have a lot of substitutes. They have some. Like you go here in New York, okay, the big bus or whatever the heck it's called, right? You can do that. You may not fly to New York, but if you go 500 miles, 1,000 miles, you go to Europe, you got to fly. And so that's the point. They don't have a lot of substitutes. Although one thing that changed a little bit in the pandemic was Zoom. Like we were all locked in our houses and you were taking classes online, which sucked. Businesses realized the same thing. They didn't have to do business travel to do meetings. And even today, the business traveler is doing more Zoom meetings than they did pre-pandemic. That's a substitute threat to the airline industry. Airlines don't like that. They want you on a plane to go meet with whoever you're going to meet with to sign that deal. So the point is, how do those five forces explain the spread that you see? That's the next step. Then, and this is where the future comes in, how do those forces change in 5 years? Because if the forces don't change in 5 years, then the spread's going to be about what it is today. If the forces get more favorable in 5 years, then the industry spread's going to probably be higher. And if the forces get worse over the next 5 years, the industry spread's going to get lower. So you're essentially going to back forecast the industry spread by basically talking about the change in the forces over the next 5 years. Now, some of you are probably sitting there saying, oh my gosh, I don't know anything about Disney and what's happening in the entertainment industry, because I got to talk about theme parks, I got to talk about Disney Plus, I got to talk about Disney has cruise ships. Like Disney's a conglomerate, and I got to figure out what's going to happen with them now in the 5 years. I don't know enough about that. I can't even afford Disney Plus. What am I going to do? Here's where your Bloomberg certification and tool comes in. So a couple hints. Number one, BICO, Bloomberg Intelligence on a Company. Bloomberg has a primer that they give on companies to investors saying, here's what's going on with the company as it relates to the industry. So a lot of the answers are in BICO. Number two, BI, Bloomberg Intelligence are industry dashboards. Search an industry dashboard. In this case, airlines. This is the airline dashboard. Here's the industry primer. Here's what the analysts are saying about the airline industry now and into the future. So a lot of this analysis that I'm expecting you to do is right here. Number three, BRC. These are the analyst reports on Delta Airlines. We have access to what JP Morgan, Barclays, and Deutsche Bank are saying about Delta Airlines in the future. Any one of those is fair game to help you do your assignment. All right, now I'll be really clear about this because we are an academic institution and there's a bright yellow line. You're going to need to use this data to answer the questions this semester because we're doing real world companies and it's perfectly acceptable to do so, but you can't plagiarize it. So therefore, if you cut and paste quotations, footnote. If you refer to this, source bibliography, okay? Because every paper you submit is going to go through a plagiarism checker, which is really good. And if it flags you for plagiarism, my definition is 30%. If your paper is 30% or more similar to any other paper that's ever been submitted or uses 30% source information that's out in the real world, you go to the Honor Council and you lose. Okay? Now here's the point. If I see a footnote and I see a bibliography, that's not plagiarism. Okay? If I don't see a footnote and I don't see a bibliography and I see a big cut and paste, that's plagiarism. You can't do that. So what I'm telling you is you're going to need to use real sources, and it's okay to use sources, and I want you to use sources because you don't know many of the companies that we're actually working with. And it's perfectly okay because the analysts are trying to do the exact same thing we are, to use their information about today and tomorrow to answer the questions. Just source it, don't plagiarize it. Is that clear to everybody? All right. Now, final source I'll mention is in ELMS under VBIC homepage, link there, which is the University Library online. There's a subtab called Industry, and one of the industry data sources we have access to is something called IBIS World. IBIS World writes professional industry reports for any company. So I type in my company or industry, like let's say I type in airlines. Here is their domestic airline in the U.S. industry research report, which is basically a 5 forces on the airline industry. So again, use IBIS World, okay, for Disney. Use BICO, use BI, use BRC. A lot of information to answer the questions about today and tomorrow in the 5 forces. Does that make sense? Questions? That's I. The final part of this is C. C is competitive advantage. The second screenshot will be used for I and the C. You must submit for Disney, now this is the Delta one, the RV custom spread screenshot. So you got to take 2 screenshots. One is RV markets beta. 2 is the RV custom spread. When you talk about industry attractiveness, explain the 5 forces, you have to use the data and refer to the screenshot that you're submitting. When you do competitive advantage, you then talk about the company's relative spread to the industry. Delta's relative spread, 10.26 minus 8.39, slightly higher than the 9.11 minus 7.83 industry. We talked about this last week. Delta demonstrates a little bit of competitive advantage. In the C section, why? Explain. Why is Delta slightly outperforming all the other airlines? What makes them a little better? That's the other context of the C. Today. And finally, will that change in 5 years? Will Delta's relative spread to the industry get better? They'll improve on their competitive advantage? Stay about slightly above industry average? Or will they go to average or below? What do you think is going to happen? Now, here's the point. Somewhere in, when you go through all this data, your opinion is going to come out of this. Because we're talking about the future. All right? And none of us know what's going to happen in 5 years. You're going to have to make, essentially, an interpretation of what the 5 year is. Right? And your grade is not going to be necessarily whether we agree or disagree with you. If you're following a process and you're referencing data, we can't say that if you say the industry is actually going to get tougher and competitive advantage is going to get worse, and here's why, and somebody else says the industry is going to get better and competitive advantage is going to get better, both can get perfect scores in the homework if they're well sourced with rational logic using the formulas and data in this class. Does that make sense? But that's your homework too. Monday, 10 a.m., minimum 500-word paper, 2 screenshots, the markets beta and the custom spread for Disney and the entertainment industry. Now, just so we're all submitting the right screenshots that are the same, when you go to your assignment, I am telling you to use the BICS best fit algorithm and country of domicile for your comp source. All right, so we're all using the same comp source and same peers and same numbers for this assignment. Make sure you do those screenshots based on that. All right, questions about anything related to EIC? at this point. All right, Bloomberg Trading Challenge. At this point, is everybody in a group? Is there anybody that did not drag themselves into a group? 201 through 206. You're not in a group?
Yeah.
You're not in a group? Can you drag yourself into one of the open groups? Okay, both of you just quickly drag yourself into one of the open groups. Can't have more than 8 on a team. So team 5 seems to have a lot of openings. So maybe go to team 5. So besides those 2 people, anybody else not in a group? So we need groups more than 3. All right, if we're just, some people are, like I said, I got a bunch of COVID students, so they might also not be able to drag themselves. So nonetheless, if you don't have more than 3 people in your team by Monday, I'm going to rob some people from other teams and move them to your team, but by Monday. But for now, you guys are going to start as a team. All right, so here's what I'm going to do. I'm going to give you 5 minutes to break up into your team and meet your team members in this room based on who's been assigned to what team, and choose a team captain for the Bloomberg trading competition who will trade on behalf of that team for the rest of the semester. Okay, so to make this a little bit less chaotic, on the left corner, team 1, here front, left front, team 2, team 3, middle back, team 4, middle front, team 5, right side back, team 6, right side front. Go meet your teammates, next 5 minutes, pick a team captain. And then I'm going to ask you who they are to register them for the Bloomberg Trading Challenge. Okay? I would log out because other people are now going to be in front of that computer.